Good morning, everybody, and welcome to another Mortgage Coach Tuesday interview. Every Tuesday, 9 o'clock Pacific, we are here to interview top people. Sometimes the top producer. Last week, it was a top producer. Today, it is Dan Rawitch, who really needs no introduction. If you are a new loan officer, I will just say this is a man that you need to follow. He does a morning update in our Rate Watch app every single day. And if my kid was getting in the mortgage business, one of the 5 most important things I would tell him to do is listen to Dan Rawitch every morning, and you'll start understanding how what's happening in the marketplace and changes what's happening with interest rates. So what's up, Dan?
Hey, Dave, how are you?
I'm good, man. Thanks for making time last minute to come in and bring a special update. Really appreciate it, brother.
Yeah, thanks for having me.
Yeah. So community, before I just tee up Dan, I want to say this. I think, to crush it as a local referral-based mortgage professionals, you need to be looked at as an advisor, not just someone who could close a loan on time, who has great rates. People need to look at you as like an advisor, captain of the wealth team. The mortgage decision is the most important financial planning decision families ever make, and we want to help them make a smarter decision. So the more you know what's happening in housing, what's happening in your local market, and what's happening with interest rates, the smarter you can be, the more confident you can be. By the way, new loan officer, that's a shout out to you. The smarter you get on this, the more confident you will be. And so Dan and I were talking, I don't think it was over the weekend. I think it was Friday. We were syncing up, and he's like, Dave, there's some very interesting things happening with these predictive cycles that I think loan officers should know. It would give them more confidence, and it would give them more clarity. And so this is a little more of an advanced update than a lot of things that we've done with Dan. He will give his interest rate projections, but guys, I just think it's important. And it's September. Literally, it's the month before we start going into that Q4 wind down. So guys, buckle up, turn off your mobile phones, listen to Dan for an hour. Do want to remind you guys, this is a mastermind style conversation. So if you have questions for Dan, or if he says something that you really like and it's a bullet point, put it in comments. This is interactive. Let's make it as interactive as you guys will make it. So Dan, I'm going to jump off camera and let you drive some Dan Rawitch market updates.
All right, let's do it. I'll share my screen here.
Hey, Dan, real quick, and you can go ahead and share your screen, but if there are new loan officers listening to this, would you mind just giving why should they listen to you every morning and watch that Mortgage Coach video every morning from a Dan Rawitch perspective?
I missed the first part, Dave. Give them what?
If there's a new loan officer listening to this, why should they be, downloading Rate Watch, and why should they be listening to you every morning in Rate Watch?
Yeah, no, got it. Thanks. So out of college, I was a bond trader. And while I was in college, I was a mortgage loan officer, and my goal was always to be in capital markets. And so when I graduated college, I was recruited by Bear Stearns and kind of lived out my dream, which turned out to be not quite as cool as I thought. Some things just sound cooler than they are, but working on Wall Street in the 80s, if you've seen Wolf of Wall Street, it was not that inaccurate, just not my style. But my passion for the market never went away, and my desire to trade never stopped. And so when I came back from New York, I opened up RPM Mortgage. This was in 1989. And I just thought, wow, I've learned so much on Wall Street. Is there a way that I can make that relevant to Main Street? And I had this magazine ad. Now, keep in mind, I'm in my late 20s. I'm a pretty cocky guy. I had black lacquer desk, black fancy suit. I had a computer on every desk, which was unheard of back then. And I'm leaning on my desk like a cool guy. Looking back, I look like a 12-year-old trying to be a grown-up. But it said, from Wall Street to Main Street, I know. But we played off that, and we played off that ability to look at a chart and understand how the economy was going to affect interest rates. And it actually became an amazing recruiting tool, because it turns out loan officers were fascinated by that. When borrowers came in, we had a telerate screen, which was very, very expensive back then, and it gave all the market updates you needed. And I would used to watch our loan officers and just smile because they would meet the borrower in the lobby, walk them over to the teller rate screen and explain to them what they were looking at. And borrowers would just nod thinking, wow, this guy really knows his stuff. So it really built credibility and it built confidence. And that stuff now is so much easier to learn and understand. And that's really just what I do every day, Dave, is like you said, it's something in the beginning, it might be like, huh? Because I can't always go back and do economy 101 because we have guys that have been following us for years and years and years. They don't want to hear that again. So it's kind of like be a little confused at first, but just keep listening. And one day you're like, wow, that makes a lot of sense. And I think it really does increase your confidence.
Yeah. And guys, we're talking about like 3 minutes every weekday. It adds up. So it's a simple, easy thing to do, and it will make you smarter. So if you're new in the mortgage business, I would just say the first year, it is a requirement. And then you can kind of decide, hey, do I really want to be a market nerd? Do I want to really go to school with Dan Rawitch, sign up for his market mentorship program and be a market leader? So you can teach and train this to realtors and loan officers and literally be the smartest loan officer in your market. Or, hey, do you just want to do that 3 minutes a day? You get to choose how deep you want to go. But if you're new in the business, guys, first year, it is required study time. So Dan, rock it out. What do we got? And why do you think it's so important to share this update?
Okay. I just want to make it clear. It was, I don't know, maybe 2007, Dave asked me if I would do this because he had the idea to make Rate Watch part of Mortgage Coach. And he decided back then, let's do this as just free content for originators. And we've always been committed to making Rate Watch free, and it still is. So there's no catch, just tune in and listen. And then if you want to know more, learn more, get to another level, we could talk about that later. But Rate Watch it's a gift. Okay, so I'm going to begin with just some real quick economic slides, and then I'm going to go into time cycles. And time cycles are very complex, and some of it can sound like voodoo economics, witchcraft, whatever. My goal here is to convince you to the extent possible that time cycles are very real, not completely understood, but very real and very dependable. So let's just start with a couple real brief economic slides. Let me blow this up here. Oops, I went the wrong way with that, didn't I? Oh, it's on the wrong screen. That's okay. Hopefully you guys can see this okay. So first of all,
hey, Dan, this is a really quick fix. So let's just within the screen here, you don't have to change your screens. You can just change speaker view. So look for that little, no, put it.
I know, Dave, but when I do that, it's showing on my right screen. So I have to go back in and just turn off that screen, which I did.
Okay. Well, don't worry about it. There was another way to do it, but go ahead and share.
Oh, well, go ahead and tell me. Sorry.
Good enough.
Tell me.
We'll put it in presentation mode.
Okay.
And so this is the speaker view. Where is it?
See, the right side of my screen is actually
in the bottom left-hand corner. You've got a couple icons. Click on not that one. Go to the other one. No, to the right.
Zoom into the screen, or
what's that one say?
Toggle subtitles.
No, and then
block or unblock slideshow.
Click the bottom, the little bubbles. The circle with the 3 dots.
Okay. White screen, hide presenter view. Let's try that.
Yep, that's it. Boom. I knew we could do it. All right, let's roll.
Okay. Yeah, it still didn't blow up on the whole screen.
Oh, I got it. Yeah. Anyways, we can see your screens. We're good.
Hang on. Sorry. I think we could do this pretty quick. I don't know why it reverted back.
So guys, we're doing a little tech support where you're sharing slides. And let's say you had a group of realtors, you get ready to do this Zoom. You can either troubleshoot it the way Dan's doing it, or you could just not go into presentation mode and leave your slides on the left-hand side. Either way, it'd be good. So if this works, let's do it. And if not, let's just roll.
Yep, there we go.
Boom, we're good.
Okay. All right. So let's start with some quick economic slides. First of all, by the way, what you're seeing, some of these slides went out last night to our members. Every week I do a weekly video that kind of prepares them for the new week, talks about what happened the previous week. So look, the economy is going in the wrong direction. And what's fascinating to me about that is Fed BS is our term for the manipulation the Fed continues to have in the marketplace. And it's way deeper and way more serious than anybody realizes. You can look at the member bank, the Fed banks, P&L quarterly, and you'll see a line item that says miscellaneous trading activity. That's Fed manipulation. That's them pushing the market down and then buying at the bottom and selling at the top. The Fed also continually just puts money into the system. And historically, what you can see, the gold line is the Fed BS. And as that goes up, then the economic surprise index, which is the purple line, goes up too. So Fed manipulation equals help to the economy, except not now. All of a sudden, the Fed's BS is not working, and we keep seeing a downslide in the economy. This is why I'm bullish on interest rates longer term. This is another look at the global economic activity surprise index. Look at how far it's fallen, guys. It is now around where it was at the very low of the pandemic. You can see after we came out of the pandemic, it got better and better, and then came crashing down. This is not a good sign. In light of all of the stimulus just keeps coming. This is just a small picture of what I'm seeing. This is kind of an inverted chart. This is the decline week over week and people passing through the TSA gates to travel. This is how bad it was at the right when the pandemic got at its worst. And then you can see it was all pretty good, but all of a sudden, and this is of course the Delta variant for COVID. The reopening, when it comes to reopening America, you're seeing sudden mobility trends completely reversing themselves. So this was during the lockdown. This was post-lockdown. It kept getting better. It's now turning down more than we've seen it turn down in quite some time. Consumer spending is softening, which is not good. And then last but not least on the economic slides, there's 10 million jobs open. And this is a problem. We can say that the non-farm payroll being as terrible as it was on Friday, terrible. It was about 1/3 of the expected jobs were filled. And historically that would be because there aren't any jobs. But in this case, there are too many jobs. And so you would think, well, that's a better problem than the reverse of there not being any job, but it's not, because the problem is if people don't want to go to work, they cannot produce. Without production, there's no consumption. Without consumption, there's no economy. Without an economy, there are zero interest rates. So this is personally where I see things going. However, we did have the 1979, 1980 era, which had stagflation. That's when the economy completely stagnated. We went into a recession and we had inflation. It's only happened once in my lifetime, and I'm 62 years old. I look good though. But so I want you to keep in mind that it's not very likely we'll see stagflation, but it's always in the back of my mind. I was actually in the mortgage business while I was in college in 1980 and 1981, and I saw 30-year fixed rate loans hit 16, 17%. I was selling adjustables at 14. By the way, I did pretty well. There was still plenty of business. But on the inflation front, which I've been very vocal that it is transitory. I'm not one to always agree with the Fed, but I think he's got it right this time. The question is, how long is transitory? And my concern right now is these shipping costs just keep going through the roof. And until shipping costs calm down, I'm not going to be convinced that transitory inflation has seen its days. Although you can see this little downtick here, which is good, but we saw one here only to resume. We saw one here only to resume. So hopefully it'll start working its way down, just like lumber did, guys. You saw lumber prices. Lumber has since crashed. Now, rent is a big component of CPI. And these rent increases, you'd have to beat me in the head to convince me that rent increases are not transitory. They are. Why? Number one, forbearance. Nobody can foreclose on anybody. So you have all these borrowers that haven't made a payment and I don't even know how long. And many are believed that they won't be able to make their payments. So they're going to have to leave their homes. Number two, evictions. I feel so bad for mom and pop landlords. Heck, I'm one that had these homes that they couldn't collect rent. They still had to make their mortgage payment because they couldn't evict. So you had two markets that froze people in their homes, that sucked up all the inventory. If you tried renting a home in the last 12 months, it's pretty depressing. That is going to change post forbearance, post the eviction moratorium. You're going to see a lot more rental homes come on the market, and you should see rental prices normalize. And that is actually going to bring down CPI. Meanwhile, we haven't seen the full effect of rent increases in CPI. All right, this is interesting. It's my first hint towards seasonality and why seasonality matters. Each one of these colors is a different year, and each one line begins in January and ends in December. So you can see here, 2014 rate started here, ended here. What's this color? 2015 rate started here, ended here. 2016 rate started here, ended here, and so on and so forth. I believe there's only one time on this chart that rates ended up higher than they started the year. And we're currently in 2021, and we're seeing a lot of backup in rates. Slightly outdated because we know the 10-year is not 1.9. Oh, I'm sorry. This is where it's forecasted to close the year by Bank of America. I don't think it's going to get that bad, but still the year closes better than it started. 2022 is forecasted maybe to go the other way. We'll see. But I thought this was interesting. It shows you that patterns do repeat themselves at the same times of the year. This is where we're at right now. If you back away and you look slightly longer term, this chart goes from May until now. If you've been following me on Rawitch, literally, I don't know how many weeks in a row, I've drawn a very similar pattern. And what this is telling you is this is yield. So the yield has been trending up since about August until now. And this is that trend line long term. It's also been trending down since May of 21. And this is that trend line. And when these two things form a wedge, it becomes a very powerful pattern. And when whatever way the yield breaks from this wedge will tell you pretty much the direction that probably the year is going to end. And it will. So in other words, if we break to the high side, it could get ugly. We could go back up here and test these highs. If we break down on the low side, we could come way back down and test 1%. I wish I could tell you which way it was going to break. Once we get through the seasonal pattern that I'll talk about, that's really upon us, I am bullish. This is the Fed futures. So this is Fed funds, and they are slowly inching up the Fed funds rate just beneath everybody's eyes. It's happening. And this is the Fed's way of just kind of not shocking the market, but kind of throwing out these little hints to traders. This is a concern that I have, and it's the reason why probably the Fed can't stop doing what they're doing. It's hard to believe, but this chart should convince you that the Fed's purchase of MBS has a direct correlation to home price appreciation. Just stare at this for a minute. This goes back to 2008. This darker blue color here, this one here, is the Fed MBS purchases. And the lighter blue is the CoreLogic Case-Shiller Home Price Index. You can see in 2010, the Fed backed off, home prices fell. You can see in 2012, the Fed began QE, began buying MBS like crazy, and they drove home prices up. Fed calmed down, prices calmed down, Fed backed off, prices fell, and then the Fed just stomped on the gas pedal after the pandemic, and there went home prices. So you can only imagine right now, with there being a little bit of a bubblish feel in the housing market, I'm not predicting a crash, but you can imagine if the Fed completely takes his foot off this gas pedal and tapers, what could happen. Homeowner vacancy rates are lower than I've seen. This goes back to 1956. 1956. I was born in 58. It's my whole lifetime. We've never seen vacancy rates this low. That is clearly driving up rent prices and home prices. This, in my opinion, again, is transitory, because when the forbearance stops and the the eviction moratorium stops, you're going to see vacancy rates increase and prices soften. And that's good for CPI. That's good for inflation. Another just concern about housing prices right now. Check this out. Housing prices have grown almost 5 times faster than hourly earnings growth in the US. Never seen that in my lifetime. I think this says it goes back to, oh, it doesn't give a time period, but you can just see this and then look at going back to 2015. This is insane. It's not sustainable to have home prices grow faster than income for a very long period of time, and certainly not 5 times faster. So again, I would say if the Fed starts tapering, these things are going to start mattering. On the positive side, and I think this is really important, and I'm going to just share with you my homeowner speech, my speech to my children. Don't buy a home for appreciation. I don't think that's what it's about. I think appreciation is a delicious frosting on a cake, but buy a home because you want to pay it off. Pay that thing off as fast as you can. And you're going to end up retiring with more money than you can think about if you do this now. If you don't do this, you're going to end up renting your whole life and end up with nothing. And that doesn't matter if home prices appreciate or not. They always have, they always will. This goes back to 1980. You can just see steady up. There are pullbacks, but I don't think there's a huge point in timing the market, because in the end, if we do have inflation and it's not transitory, there is no better hedge against inflation than owning a home. There is no better hedge than owning a home. So anything I say about worrying about prices pulling back, I would say to a homeowner politely and kindly, who cares? You're going to raise your kids in this home. And I've used the story many times, but my daughter, I helped her buy a house. I think it's been 5 years now. Her payment was $1,700 a month. She was freaked out about that payment. I said, Ash, that payment's going to seem so low in the coming years. Back at that time, she bought in like a real remote area in California called Red Bluff. The average rent in Red Bluff was about $1,200. So $1,700 house payment was kind of high. Now her house payment's still $1,700. It's cheap to her, and the average rental price in her neighborhood is closer to $2,000. So, oh, and by the way, she now has like $200,000 in equity. This is a kid, they're at that age, kind of paycheck to paycheck, but they have a huge fallback because of their home. And then again, on the positive side, as crazy as our housing market's been, not even close to what's happened in New Zealand, Australia, Norway, and Ireland. This tells us we could go a lot higher. This is just, again, all these slides are yours. I will give them to Dave and to Robert, and I'm sure they'll put them up on the Mortgage Coach site. But I thought this was interesting. There's only one city in the US that is not seeing higher home prices post-crash. And you can see some of the problem cities could be these top ones that are now 50 to 100% higher than they were pre-crash.
Hey, Dan. So first of all, thank you for sharing the slides. Everybody, those will be in the files section of our Facebook group. So when you go to Mortgage Coach Productivity Mastermind, in that group, there's a file section, and there's tons of gold in there. We'll have a label, so it'll be descriptive, Dan Rawitch special update with a date. Go ahead and download that, check it out. Catherine had made a shout out earlier in the presentation saying, I used that rental slide this morning in a realtor chat. So first, Kathleen, great job. That is why Dan does that. You're clearly part of the market mentorship program where, Dan's given us this special, let's go deep, but he's got a platform called marketmentorship.com where he's providing, advanced slides like this all the time, on a daily basis and weekly basis. Anyways, keep it going, brother. And David said, love the details. This is great. Jolin said, wow, what a presentation today. Elizabeth Rose said, this is great information, Dan. So guys, we like nice comments too. If you have questions, put them down there. But if you just have nice things to say to Dan, keep sharing. He loves that kind of stuff. It's why he does what he does.
Yeah.
All right, brother. Keep it
all
rolling.
Those comments tell me I'm hot today. All right.
Yeah, right.
So this is telling you again why CPI might get a little worse. Did you know that CPI, that rents are 40% of CPI? That's a big number. So as these rents are hitting these unprecedented levels, that is affecting inflation.
Wow, I did not realize it was that big of.
Yeah, and that actually said that a couple slides ago.
Yeah. Anyways, you just put an exclamation mark on it. Like,
Mhm.
wow.
All right, let's talk about time cycles. Time cycles, they freak people out. They're very hard to believe. And in fact, before I go into all of this, well, while you're looking at the slide, I will tell you that there is a time cycle foundation study of cycles. It's been around since the 1800s. Two past presidents have been on this board. And you have very famous economies, Edward Dewey. How about this guy, William Forbes? This stuff is real. As much as you can't always explain or understand it, it's real. And before I really go too much farther into it, there is no better way to show you than right here. Wait, where's my, sorry guys. Here we go. Let's go here. Let me blow this up. I'm going to take this all the way across the screen.
Yeah, no, it's pretty blown up.
All right, ready?
Ready.
I'm going to type in as an indicator moon phases. You can call me a quack right now if you want. Go ahead. This is a new moon. Rates, prices go up on a new moon. This is a full moon. Prices go down. Look at how uncanny this is, guys. I mean, up, down, up, down, up. And what I want to do is bring on the S&P, bring in SPY. And I want to show you the pandemic. If you were trading just on moon phases, you would have shorted on this full moon and you would have become pretty wealthy in this singular move. If you wanted to go long here, you would have made all this money. Short here, you would have made this. Long here, it's pretty uncanny to me. And there have been many people like Edward Dewey that have proven that time cycles also involve planetary moves, sunspots. Look, all this stuff affects our world. The oceans, the tides, the waves, they're all affected by the moon, right? You can't tell me that other things are not affected. So let me go back here, blow this up. Oopsie, that screen came back. That's okay, we're gonna stay with this. So W.D. Gann was a famous trader, one of the most famous, arguably made more money than any trader in the world that's taken old dollars, inflation adjusted. And while he was being basically fact checked, because there was a faction of people that didn't quite believe what he did was real. They tracked him. He made 286 trades in 25 days and 264 were profitable. Everything that he does, W.D. Gann, is about angles and time cycles. Like I mentioned before, there was an institution study of cycles. Andrew Pincelli, this guy who I've followed for many years.
Hey, Dan, real quick, your presentation has gone back into that presenter mode. And if you just don't go in presentation mode, we can actually see the slides better. So either go out of presentation mode or.
Yeah, let me.
Because at least we can see, 80%.
It just takes 1 second. I think.
And remember, guys, you're going to get all of these slides. There we go.
I don't know why it does that, but.
Yeah, don't worry about it.
Here. All right.
While Dan's getting that done, Jeff Curtis said, Dan is awesome. His daily commentary through Rawitch has helped me with borrowers and helped me look really good with clients. So thanks for sharing that, Jeff.
Yes, thank you so much, Jeff. So every month I get Andrew's report. I pay a fair amount of money for his research. Up until recently, his research was only available to hedge funds, and he would charge up to $500,000 to $1 million a year for his reports. Things like grain report, wheat report. All these commodities are very affected by time cycles. But essentially, every month I get his reports, and they tell me the coming months where the key dates are and what's going to happen. And it looks like this. So these histograms, these come from world events that have happened as much as 800 years ago. And when these events, and they could be anything from a weekly cycle to a decennial, to a centennial, depending on the strength, the length of, and the amount of cycles that come together. This histogram registers what's going on. And these histograms very accurately predict movement of the market. You can see here, whenever this was, I can't see the year here, but in December, a bunch of these histograms came together. It called the bottom of treasury bonds. You can see a bunch of these histograms came together here, called the bottom. This one called the top, called the bottom. Now, these don't have to be like, oh my gosh, you know, the world is cratering, but they can be very significant moves. 80% of the time, these histograms will tell you there's a reversal coming. 20% of the time, they will tell you that there's an acceleration of the current pattern. And the way we know that is I'm always tracking and drawing on the charts. So when these histograms come into play, so this move has been really big. This move was 100% forecasted. I called this move. I spoke at an MBA or a CMBA event about this date. I called this bottom so perfectly, and it was because of these time cycles. Well, they're coming into play again, and this is why I wanted to talk today. Sometime around the 17th, we could see a pretty big reversal in bonds, because the same events that drove these histograms are events, they're not just things, are coming into play once again. And this time it suggests more of a reversal. On the other hand, you can see there's other things coming that could turn that around. But there's this going on, and then there's a seasonal move that plays into this as well. That's making me a little bit nervous. Here's some more example of how these histograms work. Some of you that followed me back in after the pandemic really got bad in 2020, I was able to call the biggest move in oil we've ever seen. And it wasn't my work, it was Andrew Pincelli's work. And these histograms were just screaming at us. There were world events going back way, way, way back to the Middle East that suggested that there was going to be turmoil in the oil market. And almost within the day, we called the top of oil. And you can see these histograms do a pretty good job. So every month I read these reports, and it tells me what the key turning point dates are going to be. And you can see this was in July. It told me on August 20th, there were time cycles coming together. August 20th, you can see what happened. July 20th was another turning point. He suggested, you can see what happened here. That's the S&P, that's gold. And what I want to be clear about, these are faded. These are done. I can go as far up as you want. This didn't come from this. This came from the time cycles. Here's another example of just, there's a 9/56-year cycle in financial panics. And just real quick, I'm not going to go through all of these, but this is the sequence 3, 5, 9, and 12. So what this tells you is, for instance, in 1819, there was a US crisis and there was an English crisis. And then, so if you go into sequence 5, which is 2 years from sequence 3, you can see then in 1821, there was no crisis in that case. But in 1889, there was a Friday the 13th panic, German shock stock market. These sequences play out over and over and over. And by the way, the very first time cycle was done when, was it Roosevelt? The US president at the time of the Depression hired Edward Dewey to say, why did this happen? And so he went into this incredible study going back hundreds of years. Okay, so this part is really, really cool if you're a historian. I really struggled last night to talk about how can I best share this data, because it's a whole bunch of data, it's a whole bunch of bullet points. I don't love reading charts to people, but the importance of the data is we're skimming through. Do you have something, Dave?
Yeah. So first of all, guys, I want to remind you, ask any questions you have. Takeaway right now, just take Dan's word for it. Predictive time cycles matter. You know, he was trying to make a case that, you know, look, I use them and look what happened. But if you listen to Dan Rawitch and you trust him, which I do, they matter. Takeaway number 2, September 17th matters. And then Dan, I don't know when you want to answer this next question, but because I don't know how many more slides you have, but at some point I want you to leave enough time in this to be very tactical with, hey, if I'm a loan officer, this is what this means to you. And this is the conversation you should be having with borrowers. Or, hey, this is what this means to you. And this is the conversation you should have with realtors, so that you go from data, insights, what you think is going to happen. And I don't want to run out of time. I want you to be able to give not scripting, but specific tactical advice for both borrowers and realtors. Okay.
Okay. Yeah. And I think I told you, Dave, I got a class at 10 a.m. For options trading.
Well,
So
that's why I'm like, I want you to leave on time. And you might even want to go from, hey, you given the data, you give that advice now, and then you see how much of the data you can get. Because I want to get you off in time, but I also want to give very specific advice and direction to people.
all right. Let me just skip most of this and tell you this is historic history going back 800 years to what's happening in Afghanistan. We were able to predict the turmoil and what happened in Afghanistan almost to the week based on this data. It's unbelievable.
Crazy.
It goes back from kings being assassinated, and then you have 800 years ago, we have 8 100 cycles. We have 2 90-year cycles. If you follow cycles, you'll know that certain time frames are very important and will continue to repeat themselves. All of these things have continued to lead towards this 250-year transformational cycle, which also peaks. It should be 2024 and 2026. You can see geopolitical crossroads coming. With all this backdrop, there are numerous weekly cycles coming together as we approach mid-month. This cycle, this ties in with the 90-year cycle. Get ready, 90 years ago, Britain left the gold standard. Several months ago, we saw a similar set of cycles come together. We predicted the bottom of bond prices. The histogram suggests we're at the top for bond prices and may see a reversal between the 14th and 17th. Okay. Now there's one, this is just more stuff on time cycles. This is Adobe stock going back from 88. This is the period of about February. And this is the period ending about May. And you can see this is not a year. This is an average of what's happened to Adobe stock over the last 20 plus, almost 30 years. So here's his treasuries. This is kind of drawing here to a conclusion. This is where we are now. On Friday, I told everybody on Rawitch, I'm a little nervous because we're getting into a seasonal challenge. I even said we might see a bounce because of the job data, but that the seasonal influence could really overtake what's happening with the news that came out. And what we can see here is the majority of the time, bond prices go down between now. Now this is in conflict with the time cycle. So just know that these things could offset one another. But I believe strongly that we'll continue to see more pressure come until mid-month. And then only at mid-month will we know, with all these patterns coming together. Remember, 80% of the time they mean a reversal, meaning rates would go back down, back up. 20% of the time they're an acceleration. Well, this begins about September 18th, and you can see we have a nice, strong seasonal influence. This is 19 years worth of data, and this ends at the end of September. And then you have this long range fall again. This is a type of thing that's good to show borrowers, hey, if you're thinking about locking, you might want to do it now, or unless you want to wait until here. But if you wait until here, we have this other problem, which is, the historic data against you. This is just showing you, this was 2020, taking treasury prices from May until end of August. And you can see how prices followed. This is not 2020 here. This is 19 years of data. And you can see how perfectly well it lines up with what happened in 2020. And then these are dates. We put this together every month. So I know, come these certain dates, what to watch out for, whether it's in equities or gold or oil. Okay, so let me quickly, before we run out of time, and so I still have time to answer questions and then kind of draw a conclusion. If you're interested in learning more, we do have this program called Market Mentor. You can check us out at marketmentorship.com. It's literally on every slide. Personally, I think it's a good deal. $17 a month. You get content every day, 2 to 3 meaningful articles every day that will help you know what to share with your clients. Got something, Dave?
No, keep
Oh,
going.
okay.
I mean, I'm gonna say something, but yeah, finish what you're.
So I do 2 live updates. I do them in the morning. I do them in the afternoon for our members. And there we just have open dialogue. You can talk to me, whatever you want, twice a day. You know, you've got open channel to me, and you're going to get a very in-depth update. And we also record them. So if you can't make the live update, you get it. You also get the video every week, which is a lot of the data I shared today, and 5 to 10 stock picks each week. I will tell you, in the last 6 weeks, we've only had 1 down week, and it was down less than 1%. And we had some weeks up over 6%. That's for the week. So you get that. You'll learn how to read a chart. Within 2 minutes, you'll understand the direction that that chart is going. You'll know how to predict when investors are buying or selling. You can know when the Fed is moving. It'll help you predict the home prices. These are some of the stock alerts that we gave to our members. You can see we told them to buy beyond here. And that's what happened after that. We told them to buy space here. That's what happened after that. And then testimonials. So that's the deal. Become a market member, marketmentorship.com. I've never done this before for Market Mentor, but we're offering a $1 trial for 30 days. Cancel anytime you want, and you only pay that $1. Yeah, that's it. So, let me just summarize to help.
Oh, go ahead, Dan.
So this is what I would be telling clients is,
wait, Dan, before you give the client story, guys, this is a no-brainer. Kathleen just came in, said tremendous value, just do it. Again, I can't emphasize enough how valuable it is to have daily access to Dan personally. You know, it's got a chat, so you can ask questions. For Stacy, who wants to know about the option class, again, if you want to have a direct relationship with Dan, marketmentorship.com, and it's $1 for a 1-month trial. Check it out. There is a link. We just put it down below. If you're watching the recording this in YouTube, there is a link down below. So Dan, I know you got to jump quick, so I'll let you answer that question as quickly as you want, and then leave when you need to.
Okay. So we're at a very interesting time period, guys. We have the Fed.
Hey, why don't you stop sharing your screen, Dan, so we can just see your eyes while you're talking to this part. All right, cool. So fireside chat with Dan, and he is giving you specific tactical advice on what should you do with borrowers and what should you do with the agents, knowing what you know now.
Yeah. First of all, I always encourage borrowers to make their own decisions. My goal is to arm them with data so they can make an intelligent decision. I never have, and I never will get in a position where I am claiming to be a predictor of the economy or of interest rates. I am a guy that puts out hypotheses. And if this happens, then that. If this happens, then that. And based on all that information right now, we have the Fed threatening to taper. I think it'd be a big mistake if he does. But at the same point, he has to at some point. We have to get off this roller. It's not even a roller coaster. It's whatever goes straight up and doesn't come down. At some point, they have to stop propping up the market. When they do, it's going to be ugly, and rates could get ugly. And I think that borrowers should understand right now that rates are as low as they've ever been, and there is some risk out there that they could get worse. And that should motivate people. I don't want to instill fear just to make a sale, but if there is reasons to be fearful, I'm going to tell people that. On the other hand, I'm going to show them the flip side. We have the seasonality that could be a plus coming up, but you're taking a bigger risk. And I believe that you have more risk of waiting than you do of acting now. I think the upside is, I think you're in good shape now, and the downside could be pretty bad. But full disclosure to you guys, I think we're going to see lower interest rates than we've ever seen sometime in 2022, because I think the economy is going to backslide.
Got it. So guys, this is time to be a master of the cost of waiting conversation. Some of the slides that Dan gave you are evidence that, hey, there's risk in the market. and then be able to show that to a client. Hey, based on your assumptions, what are rates today? What are values today? What could they be? What if rates went up? What would that do to your affordability? How would that compare to buying today versus waiting, guys? So it is time to get on the phones. Make sure, to Dan's point, you're not talking people into locking rates. You're just saying, hey, based on these assumptions, what do you think is going to happen? What is the best case and worst case? And you're using this to drive. It is a sense of urgency, but it's based off the customer's assumptions of the marketplace and your help for them to realize that there's risk in this marketplace. So guys, if you have more questions, put them down below. Dan, when do you actually need to jump off this call, just to make sure I get it right?
I've got probably 5 minutes.
Okay, so
Yeah.
I'm going to get Dan off within 5 minutes, and then I have some ideas I want to share with you guys. I'll save my suggestions. So put questions in quickly. Dan, what would be the scripting to reach out to a real estate agent? Or if I was doing a real estate lunch and learn, you don't have to, script's not the right word, but give us some discussion points that if I was going to do a 15-minute lunch and learn with agents, or I was going to have a conversation with an agent, kind of give us an outline of how that conversation might go.
So one, again, I remind you, these slides are yours. And I would say take the ones that you understand the best. You don't have to understand it all. You don't have to use it all. Take the stuff that resonates with you. I've given you a lot, probably too much. And I think about what is the macro point here? The macro point is that there is current risk with rates. And because there's a lot of talk about the Fed tapering. If the Fed does taper, you're going to see a sell-off in the bond market. We also have, I showed you the amount of shorts, amount of people that are short selling bonds is growing. It's not shrinking. Fed has been gradually raising its Fed funds rate. There's all these little hints that we could see higher rates going into the end of the year. And then I would say on the flip side, if you believe what I believe, and that is, how can this economy be good with 10 million people out of work, the lowest participation in the labor force that we've ever seen, and it's getting lower every single month? What has happened since COVID? What has possibly happened that could make the economy better than it was going into COVID? Just name me one thing. I can't think of anything. I can't think of the restaurant business, the retail business, the travel business, manufacturing. I see a lot of catch up in manufacturing. But so what I see is, as we come out of this whole mess of COVID and we normalize, that we're going to see a normal economy less than the economy was when we go in. That's going to cause the Fed to just really have to ease and push things down. I think the Fed is going to whipsaw us one more time. If you think about what happened in 2016, I don't know, Powell just snorted something and he decided he was going to taper. And we had what was called the taper tantrum. It was taper tantrum part 2. And you saw that interest rates just all of a sudden went, and then and remember how Trump was screaming at him. He was so mad. Maybe it was that 17 or 18. Maybe that was 18. And Trump was just all over his case to the point I was like, Trump, back off on the poor guy. And then Powell saw the light and he started easing and rates just went right down again. I think he might make the same mistake right now. I think he's under so much pressure about this transitory inflation not being transitory. So that would be the message. We could see things get worse, but then we should see things get better. And then, of course, there's never a bad time to own a home as far as I'm concerned. There's always a good time to own a home.
Hey, Dan, someone asked a question. Do I need a coupon code to get that dollar deal? I don't.
That should be built in. If for some reason you're seeing a different answer when you go to check out.
Okay, so there's no code they need. They can just go to marketmentorship.com. Don't worry about the code and just put in their information.
If it tries to charge you $24 and not $1, go ahead and sign up, and I guarantee you by the end of the day you'll be refunded $23. Sometimes these codes don't happen instantly for some reason. We've seen it happen. It's supposed to be in there. So just send me an email, dan@universityofoptions.com, if it's trying to charge you more than $1.
All right, we've got 2 minutes more with Dan. Dan, David Luna asked, how low will rates go in 2022? So just give us a prediction. If you had a guess, what would it be?
Well, I think we're going to see Fed funds rate back down to zero. I think we're going to see the 10-year one more time test that half to three-quarter level. And I think that could take fixed rates into the low twos. And that could be anywhere from the first quarter to the third quarter of 2022, unless I'm wrong, unless for some reason the economy really is good and I'm missing it, but I'm not seeing it. You saw the Citibank surprise index. You saw the consumer spending numbers. You saw the last retail sales numbers. You see the jobless claim numbers. Doesn't look like the Fed can be raising rates now.
So it's never been more important that you are a mortgage coach. You get your clients into Mortgage Coach so you could do annual reviews. You have your clients understanding how to read a total cost analysis so that when rates do go down, if they go down, which they always go up and down, it's literally, you can text and email them, I've updated your total cost analysis and I've shown you, what your payment could be less. Again, that's not a move you need to make. Sounds like until next year sometimes, but guys, get everybody into HomeBot, get everybody into Mortgage Coach, and make sure you have the team to do that. And for right now, guys, it's just time to be a mortgage coach and to be a market mentor. So guys, for $1, you can sign up for Dan's program. And obviously most of you are already on Mortgage Coach. Never been a better time for you. Dan, any closing thoughts?
Yeah, I just want to throw out one more thing real quick. This is something we've been talking about with the Market Mentor Group, and I think the timing could be interesting. If you guys would like, and we could gather enough momentum, and everybody could invite whoever they want to a webinar. You can invite your borrowers, invite your realtors, and I would co-sponsor it. Maybe we do it with 10 LOs, 20 LOs, get everybody's name on the screen as co-sponsor. I'm not looking for a penny of money, but just a way to gather your clients into one place and they can hear this pitch and you can hear me give this pitch. And because I want you guys to be doing this yourself, every week to a group of realtors.
So Dan, here's what I want you to do. Let's make that a market mentorship. You're going to do that for a crew, guys. You need to let Dan, be in his program, opt in for it, and then we'll market it. We'll help you promote it and market it at Mortgage Coach. So let's, first of all, I want to see Dan Rawitch give a presentation to a bunch of borrowers and, and what'd you say at the beginning? From Wall Street to Main Street, we know.
Yeah.
So that might even be the title of this, guys.
It's not bad.
Yeah.
David Luna will have to tell us if we can, give this away to realtors or whatever. Just make sure there's no RESPA issues.
Yeah. I don't know why there would be.
I don't think so. It's just
we just put that in the YouTube channel. So if you want to be live and invite clients, you need to get with Dan on that.
Yeah.
And it looks like Dan just gave me permission to make this available in the YouTube channel as a recorded asset for folks.
Yep.
All right. Well, everybody, thank you, Dan. Appreciate you, brother. I want to be respectful of your time. Dan, please contact to set up. Brett Dellinger. Brett wants you to reach out. He wants to set something up with you.
I love you, Brett.
What's up,
Long
dude?
time no see.
Have an awesome day, Dan.
Thanks, everybody. Take care.
All right.
Bye.
Hey, we're not over, guys. So I just want to go through as Mr. Mortgage Coach and give you guys an action plan and give you some resources to get all this done. So first of all, remember, we have daily training every day of the week. So this is a Tuesday interview, but on Monday, if you've never created a total cost analysis, we have beginners training at 9:00 on Monday. Every Wednesday at 11 o'clock Pacific, we do black belt training. So we'll teach the move up analysis. We'll teach cost of waiting. Every Thursday at 9:00 Pacific, we have Q&A. So it's group training. Today in an hour for the rest of this month, we're calling it TCA Tuesday. And we are doing some accountability training. How many leads did you get? How many credit pulls did you have? How many total cost analysis did you do? How many price exceptions? So later today at 11 for the rest of the month, we have sales group coaching on conversion. And then every Friday we do a mastermind. So I just want to remind you guys, we got a lot of resources to teach you and train you to make the most of these markets. The calendar is available if you're a mortgage coach in your advice engine. There's a calendar in there, and also on our website. Just find the calendar section on our website. Any last questions for folks? I'm checking. Facebook real quick. By the way, we got a really nice showing of folks on Facebook tuning into this. Ronald, thank you for the nice comment. Dan, you're brilliant. I'm calling December, I think, interest rates. All right. And Brian Koss, looks like you don't need a code. So go ahead and get signed up and maybe even get an enterprise edition for your group. All right, guys, we are going to wrap this up. Everybody have an awesome day. I'll see some of you guys back in an hour at our 11 o'clock TCA Tuesday coaching session. This is a wrap. Give us a like if you got value, share it with your mortgage friends.